Hey guys, we're going to have a short little lesson today about the different types of exchange rates. But before we do that, we're going to start off with some practice questions covering what we just finished last week. So here's a question that you might see on the AP exam. Which of the following best describes the financial account on the nation's balance of payments? So remember, there's two different types of accounts. There's the current account and the financial account. So I'll give you a second. You can pause if you'd like. The correct answer on this one is going to be E as an elephant, the purchase and sale of real, meaning like real estate, and financial assets like stocks, bonds, savings accounts between nations. It's not just the purchase and it's not just the sale. Remember, you can have an inflow of capital or an outflow of capital in either of these two accounts. And remember, they balance. So if there's going to be a credit or an inflow in one, there's going to be an outflow or a debit in the other. My face is in the way. It says, suppose the United States has a surplus balance in the current account. Which of the following statements is true? I'll give you some time to pause if you'd like, and then we'll go over it. Okay, so you could have paused. So usually a surplus means that there is a deficit in the other account. So the deficit is not in the balance of payments. Remember, the balance of payments is both accounts put together. They're going to balance out, so there's not going to be a deficit. So it's not A. It doesn't have to be coming from a trade surplus. Usually, probably, if there's a surplus in the current account, it's probably from net exports being surplus. But remember, there's also profit made on financial investments as well as unilateral one-way transfers of money. That could be in surplus. That makes the entire account be in surplus. So it's not only trade surpluses. If there was U.S. dollars, more U.S. dollars sent abroad, then there was foreign currency received, that seems like there's an outflow. So that wouldn't be a surplus. That would be a deficit. And then trade deficit, when the trade deficit not put it in surplus, but a deficit, that doesn't make sense. The correct answer is B. There's more foreign money, more foreign capital invested in the United States than there was investment abroad. And so there's more money coming in that creates that surplus. And here's another question. It says, if foreign dollars being sent out of the United States exceeds the dollars, I can't read. If foreign currency being sent into the United States exceeds dollars being sent out, it is said that the United States has a what? Okay, so this is an older question because it says capital account. Oh, and remember, they've changed the name from capital account to financial account. So, and then the word positive is just another way to say surplus, and negative is another way to say deficit. So if more foreign currency is being sent in to the United States, it's going to be, it doesn't say which type of currency. For what? It's not trade deficit. If more currency, is being sent into the United States, what is it being sent into? I don't like this question at all. I'm assuming that more money's coming in, so it's positive, but is it positive capital or current? It could be for either of them. I'm not going to give you a question like that. Let's move on. There needs to be more information to answer this question. I'm going to have to remove it. Okay, here's where we're headed to today. Different types of exchange rates. So no school tomorrow, which is Tuesday, but today we're going to introduce the graph that we're going to be learning when we come back from our little mini break. So we're going to be graphing currency, the supply and demand of currency in relationship to other countries' currencies. And that's what exchange rates are. It's the value of one country's currency in relationship to another country. So you can't talk about like the dollar being strong or weak unless you compare it against something. So it's always in relationship to another country's currency. So, the dollar is strong compared to the Mexican peso, but it's weak compared to the euro. So you have to compare it against something to get an idea of the value of it. And so remember, when the value of a currency goes up, it's called appreciation. When the value of a currency goes down, it's called depreciation. So appreciation, another way to say that is strong. The dollar or currency is getting stronger. If it depreciates, it's getting weaker. So there's something called the fixed exchange rate. See that little E down here? Big E, little r, that's just an abbreviation for exchange rate. A fixed exchange rate is a type of exchange rate in which a country's currency, the value of it, is pegged by a monetary authority, usually the government or maybe the central bank. They basically set the value of their currency in relationship to the value of something else. So, when we used to have the gold standard, the value of the dollar was dependent on the supply and demand of gold. So if the value of gold changed, it would change the value of the US dollar. We don't have a gold standard or a silver standard anymore, but when we did, the value of our currency would change, but only because of the thing that it was pegged against, the value of that thing changed, which created a problem when we had like the gold rush. If our dollar is based on the value of gold, and now the value of gold is drastically changing because of discoveries of gold, it's going to change your entire monetary policy because you are not having a fixed currency value. It's not stable. But the fixed exchange rates, why countries do this is they're trying to have some stability. Maybe supply and demand of that country's currency is too unstable, so they try to fix it. It could be fixed to like gold or silver, or it could be fixed to another country's currency. So some countries, I think, like some countries, I forget who it is, in like Central America, they fix their currency on the value of the US dollar because the value of the US dollar is relatively stable. And so to provide some stability to their currency is they fix the value of their currency to ours. So it's kind of like we are the gold standard and they are fixing their currency to us. A floating exchange rate is when a country's currency is completely allowed to fluctuate based on supply and demand, and there's no government regulation. The government does not put a cap of how high it can appreciate or how low it can depreciate. So no countries really have a floating exchange rate. But like cryptocurrencies, if you know anything about Bitcoin, since Bitcoin is not technically it's not a regulated currency by any government, it is completely based on supply and demand. So the swings of the value of Bitcoin have been drastic over the last decade because it is floating. It changes based on supply and demand, and so it can fluctuate from $10,000 for one Bitcoin or 50 cents for one Bitcoin. So, imagine having monetary policy that's that unstable, which is why the majority of countries in the world have a managed floating exchange rate, meaning exchange rates fluctuate from day to day, but there's a cap, there's a range of where they allow it to fluctuate. So the central bank, like the Federal Reserve Bank of the United States, will attempt to influence that country's exchange rates by buying and selling currencies to maintain a stable range. So it's like a currency is allowed to appreciate up to this amount and depreciate down to this amount, and you can be anywhere in this range, but the government, to provide some stability, is going to put caps, and they will get involved and buy and sell currencies, and therefore changing the supply and demand of currencies in order to stay in that range. So if the dollar were to appreciate in some way too high, well, let's flood the market and increase the supply of dollars to bring that value of it back down. Or if it depreciates too much, then the central bank will buy a lot of dollars, making the demand of it go back up, or maybe they'll cut supply, something like that. So they manipulate a little bit so it's within a healthy, stable range. Anyway, so those are the three different types of exchange rates: fixed, floating. Managed floating is also called managed flexible, and the word floating is also called flexible. So you might be called fixed, flexible, managed flexible instead of the word floating, because flexible means that it adjusts. Anyway, tomorrow we'll get on to learning about graphing currency, one of my favorite graphs because it's got some rules to follow. And if you follow the rules, you can't go wrong. So we'll learn a little bit more on Wednesday. So I'll see you guys later. Have a great afternoon.